Hi, everyone, and welcome to the Buffett and Beyond Stock Analysis video podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Which is me. Hello, everybody. Hi, JB.
And these methodologies are based on the book Buffett and Beyond, second edition, published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And I want you to remember that we're using the clean surplus return on equity, which is totally different than the traditional accounting return on equity. And the clean surplus return on equity is a comparable model, so we can compare companies across different industries. And it's also a predictability model. And think of your bank account, an account with a higher return or higher interest, which we can also call a return on your equity, will earn more than an account earning a lower interest. It's that simple. And since the clean surplus ROE is a predictability model, then we can equate it to a bank account. So we want to make up portfolios of stocks with high clean surplus ROEs or high rates of return because they will outperform other portfolios that have lower rates of return when we're talking about the return on shareholders' equity. Yes, folks, it's that simple, and let's get right into it. And today we're going over the air transport industry, which is a continuation of last week, but we have the package carriers, and Atlas Air World is our first stock. So, Debbie, let's see what Atlas Worldwide does.
All righty then, JB. Well, as you said, Atlas Air Worldwide Holdings, stock symbol AAWW, is a major provider of global air cargo services. It's the parent company of Atlas Air, Polar Air Cargo, 51% interest, Titan Air, and Global Supply Systems with 49% interest.
Why can't they just have one name?
Really. And they have a fleet of 103 planes, and they have about 2,850 employees. BlackRock Incorporated owns 12% of common stock, the Vanguard Group 9.5%, Dimensional Fund Advisors 8.4%, and Amazon at 6%.
Yeah, and the reason we have that in there as part of the description is because I never heard of this company.
Me neither.
And all of a sudden, here's these big people out there or big companies out there that own part of this company. So it was just, I thought I'd just throw that in there. Well, let's see how this company does as far as the return on equity goes. And there it is. We look at the clean surplus return on equity, and the average stock in the S&P 500 and the Dow 30 have a clean surplus return on equity of about 14.5%. So we want to put stocks in our portfolio that have ROEs greater than 14%. Again, think of your bank account. Do you want to put your money in a bank account that has a return or an interest rate of 14.5%? Or one that has 11.6%. Now, the thing that people are looking at with Atlas Air is see this ROE going up. That means the earnings are going up at an increasing rate. So even though this is not matching the S&P 500, we do see an increasing rate of return on their earnings. However, it's still below the average stock. To me, you might as well invest in the S&P 500. And let's look over here at the years to pay debt. The rule of thumb for Buffett, anyway, is that if a company takes all of its earnings to pay off its debt, it should be able to do it in 5 years or less. Well, this company has a lot of debt, 12.5 years if it were to pay off all its debt. So we don't care for the debt. We don't care for the clean surplus ROE being below the average stock, and we don't care for the airline or air transport industry because it is cyclical. Now, let's look how this stock has done in the past 1 year, and the ROE, which is below the S&P 500, with the S&P 500, this black line, we can see that this stock, which is the rusty colored line, has not kept up with the S&P 500 this past 12 months. And then when we look at 5 years, we can see it still not has achieved greater returns in price action, that is, than the S&P 500. So to us, this stock just does not thrill us at all. And you can see how volatile this stock is relative to the S&P 500. So, folks, I wouldn't be investing in this. And by the way, this was a question sent in by one of our subscribers to go over Atlas Air. And so, no, we don't care for it. So let's go to FedEx Corporation. And Debbie, tell us about FedEx, something that we don't know.
Oh, I'll try. FedEx Corporation, stock symbol FDX. It provides overnight or door-to-door delivery of packages and documents through its own air-ground transportation system, as we all know. And they operate more than 150,000 ground vehicles.
Woo,
a little
lot,
bit.
Yeah.
And 650 aircraft. In fiscal 17, Express segment accounted for 45% of total revenues and serves over 220 countries. That
Wow.
I didn't know.
Yeah, that's a lot of countries. Now, the reason we put this Express segment accounted for 45% of total revenues, but I couldn't find what percent of profits it contributes to. So that's a mystery for another day, folks. But looking at the clean surplus ROE, we can see just as with Atlas Air, the ROE is going up, so that means it's making money at a faster rate each year. However, it is still below the average stock in the S&P 500. And the debt is very manageable with years to pay debt of 3.6 years. And the thing is that I want you to look at this retention rate. The retention rate of 85% for 2019 means that it is taking 85% of what it makes in order to put back into the company in order to grow. That means it's paying out 15% of the money it makes in the form of dividends. But keep your eye on that retention rate because that's going to play in with the next stock that we'll see in a few minutes. Looking at the last 12 months, this looks just like Atlas Air, folks. In fact, maybe I have the wrong chart. No, I don't. This is Federal Express, and it is underperforming the S&P 500 over the past 12 months. And over the past 5 years, it is actually outperforming because the market looks at this as a growth company because it's putting 85% of what it makes back into the company in order to grow. So I think they're looking at that and saying, okay, the earnings are growing at a faster rate each year, plus it's putting money back into the company in order to grow, so it should be outperforming the S&P 500, and it is by about 15 percentage point, with the S&P up 60% and this stock up 75% over 5 years. And, of course, we're going to go to United Parcel Service, good old UPS.
That's an easy one.
Yes, so Debbie, tell us what this company does.
All right, stock symbol UPS for United Parcel Service. United Parcel Service Incorporated is the world's largest integrated air and ground package delivery carrier. The big brown truck.
Yeah, that big brown.
Big Brown also provides specialized transportation and logistics services. Services offered throughout the U.S. and in over 220 other countries and territories. Domestic package operations accounted for 62% of 17's revenues, international 20%, supply chain and freight 18%, and fleet owned and leased at the end of 17 was 581 planes and 119,000 ground vehicles. Domestic package operations accounted for 62% of 17's revenues, international 20%, supply chain and freight 18%, and fleet owned and leased at the end of 17 was 581 planes and 119,000 ground vehicles, and they have about 454,000 employees, over 62 which are unionized.
62%, which are
62%.
Now, the reason we put the number of employees in there is because when we went over Atlas Air, they have less than 3,000 employees. So you can see the difference in size of UPS. Now, the reason we brought in that 62% unionized is because Buffett does not care to invest in companies that are heavily unionized. So I just wanted to bring that to your attention there. It doesn't mean that we don't, but let's look at the numbers and then we'll decide, because the numbers tell us everything. And when we look at that clean surplus return on equity, we can see it's the highest out of the three. It's above the average stock in the S&P 500. However, it is only putting 50%, that's the retention rate, 50% of what it makes back into the company in order to grow. And that's because the other 50% supports this dividend of 3.2%, which is pretty nice. And I want to bring up one point here. here that the dividend growth rate over the past 5 years is 7.9%. So that almost fits the bill for our dividend growth and income portfolio. And then to see how this stock will perform price-wise going into the future, we take this retention rate of 50%, multiply it by the clean surplus return on equity of 16%, and that gives us a rough rule of thumb that this stock should grow at an 8% clip each year, plus the dividend has been growing about 7.9% on average. So that kind of fits the bill of an income stock, or our growth in income stock, rather than just a pure growth stock. So the market is going to look at this retention rate and say, is UPS a good growth stock relative to Federal Express, which is putting, now Federal Express is putting 85% of its money back into the company in order to grow. So let's look at UPS first, and UPS has been underperforming over the past 12 months. The S&P again is this black line, and UPS has returned a negative 2%, not counting the dividend, but price-wise, about a negative 2%, while the market is up about 7%. And over 5 years, this stock is up 10%, while the market is up about 60%. So it looks like the market is saying it's not a growth stock, and it's not going to grow very much, and therefore we rather invest our money elsewhere. So when we look at these three stocks together, we could see that UPS has a higher ROE, which would indicate to us that this stock should be outperforming the other two. However, we looked a little further and we saw that UPS is only putting 50% of what it makes back into the company in order to grow, while Federal Express is putting 85% of what it makes back into the company in order to grow. So if we did not look at how these stocks are performing, we would say UPS and FedEx would be hard to discern which of these stocks would be best, and the market will have to tell us that. Meanwhile, Atlas is sporting an 11.6% ROE, which is the lowest of all three. However, none of these stocks excite us. Number one, they are cyclical. And don't forget, as oil prices change, fuel oil prices in turn change. And therefore, not only are these companies' performances based on the price of oil, but it's also based on what the economy is doing, whether we go into recession or not. And these are the kind of companies that show up first, transportation, of whether goods are moving at a faster pace or a slower pace, which indicates the possibility of a coming recession. So that's why we don't like these stocks at all. And with these ROEs not really knocking it out of the park, now remember, to get into our growth portfolio, we want to see ROEs of 20%. So these companies are just not making it, plus they are cyclical. But let's see how they have done. And these are the 5-year charts on all these. This black line is the S&P 500, and we can see that the market is looking at Federal Express, even though it has an ROE a little bit lower than UPS, but it's putting 85% of what it makes back into the company in order to grow. And the market is looking at this, and that blue line right here is saying, yeah, we see growth in this company where we don't see growth in UPS, because it's only putting 50% of the money it makes back into the company. However, it does have a higher dividend. This chart does not show the dividend. And then this reddish line in here is Atlas Air, and you can see it's performing about average or a little bit lower than average. So folks, bottom line here with these stocks is we don't care for them very much. So remember, folks, if you want to live on the beach like Jimmy Buffett, you got to learn how to invest like Warren Buffett. And I'm sorry to say, the stocks that we went over today, we would not consider for our portfolios, because we have stocks out there that have a much greater growth rate than these stocks. But we're looking at UPS, possibly for our dividend growth and income portfolio. But then when we think about the cyclicality of these stocks, we say, no, we don't want it in that portfolio either, folks. So bottom line is, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. So folks, we had a good week. You have a great weekend, and we'll see you next time.